The Fed just announced another rate hike by another 75 basis points. But the financial markets are reacting negatively. They're actually not sure that the Fed has inflation under control. So what does that mean for the housing market? Let's get to the bottom line. Good morning. Lots of new information to go over with you today, but let's start with the staples. Mortgage interest rates moved higher once again. They were at 6.01% on average as of last week for a 30-year fixed. And with the new survey that was released by the MBA, we see mortgage interest rates increase to 6.25%. So this is a lagging indicator by about a week to a week and a half, but we see that rates are roughly 3.25% higher than they were at the same time last year. When it comes to purchase applications, we saw an increase of 1% week over week, but that still puts us down 30% year over year. So continued trends when it comes to these numbers on rising interest rates and a significant drop in application volume for this year compared to last. We got some other new data this week. One of the most important points of data was existing home sales for the month of August. So this is a measurement of how many signed contracts there were in that month. That was down 0.4% month over month, which was stronger than expectations, but year over year, that does put sales down 20%. On the inventory side of things, we saw inventory decline from the peak this year of 1.31 million to 1.28 million. That still puts us in a situation where there's about a 3.2 month supply of homes, which is considered tight. 6 months of inventory is considered to be a balanced market in general. And one important thing to keep in mind is that 39% of the inventory that's currently measured in the number I just provided is under contract. So in a normal market, about 25% of the inventory is under contract. That means that the actual supply of houses that are available for sale is at about 1.9 months. A couple other important facts to take a look at. The average days on market increased slightly from 14 days to 16 days. So homes are still selling very quickly. And then as far as the makeup of home buyers, we saw first-time home buyers make up 29% of sales volume, cash buyers making up 24% of sales volume, and investors making up 16% of sales volume. But the big news this week was on the Fed rate hike, which has been a topic of these videos at various points because the Fed has been hiking rates a lot. So Jake, tell us about what's going on with the Fed and the latest rate hike.
Yeah, thanks, Kyle. Well, we've been kind of waiting for this, and of course, it's now official. The Fed has hiked the federal funds rate by an additional 75 basis points. And, though we had expected that, the other part that they did was continue to kind of beat the drum of the inflation being far too elevated for where their goals are and their projections. And really, the market is digesting that projection pretty negatively, with the perception that the Fed really doesn't have control in the way that they're trying to allude that they do, and that they don't have a really good handle on inflation. Now, the other component of this is that we still expect the Fed to raise rates another 125 basis points. So we don't know exactly what that's going to look like, but based off the comments from the most recent meeting, it's possible to see another 75 basis point hike in November, followed by potentially a 50 basis point hike in December. They've been pretty clear that they're going to base this off of the information that comes in at that time, but it's something to definitely keep an eye on.
Yeah, definitely something to keep an eye on because we know this central activity from the Fed has a big influence on the entire economy, including the housing market. And another 125 basis points by the end of this year is a significant move. Some other commentary from the most recent Fed meeting is Powell talking about the chances of a soft landing. He's basically stating those chances of a soft landing, quote unquote, are diminishing. The more that the Fed takes action and has restrictive policy, the less the chances of a soft landing are. So they're committed to fighting inflation and getting it back down to 2%. Even though the market isn't quite sure that they're being successful in that, that is their goal. And because of that, there's definitely some concern about potential recession in the near future. The Fed actually revised their projections for GDP growth lower. And importantly, they increased their expectations for an increase in the unemployment rate in next year. So obviously that's a significant factor. Also, importantly, Fannie Mae expects there to be a recession and is projecting a recession in Q1 of 2023. So some really important indicators to keep an eye on. We're at an interesting time period in the markets where things are continuing to shift, and we're looking ahead to see what's next. We also need to keep an eye on where things stand as of today. So we'll continue to keep you up to date with the most important information to be aware of. So tune into next week's episode of The Bottom Line. We'll see you there.